It's life, liberty, and the pursuit of self-reliance. An Economy of One with Gary Rathbun.
This is our country.
Greetings and welcome again to An Economy of One. I am your host, Gary Rathbun. We're going to get right into it. I got joining me now is John Tamny. He's a senior fellow in economics at the Reason Foundation, editor of RealClearMarkets.com, and he's the political economy editor at Forbes. I first introduced to him by reading his book, Popular Economics, What the Rolling Stones, Downton Abbey, and LeBron James Can Teach You About Economics. And coming up in the next couple of months, I think, a new book coming out, Who Needs the Fed? How Taylor Swift, Uber, and robots can end the biggest bank in the world. John, welcome back to An Economy of One.
Hey, thanks for having me on tonight.
Hey, I appreciate it. We had a great conversation. I think it was in July when we talked or something like that when your book came out, and wanted to have you back. New book coming out. First of all, let's start with the news on everybody's mind that's causing the market to move around. What are you thinking of China here lately?
Well, I think what's happening in China should only scare us insofar as the government doesn't want it to happen. Let's face it, what are recessions? Because what's an economy? An economy is just a collection of individuals. And so years ago, Ben Affleck had a recession. He was making movies like Geely and Jersey Girl. So his recession was healthy. It forced him to get into the directing of films, and he won an Oscar for Argo. Chris Carter was cut by Buddy Ryan because he did not have his head right for the NFL. It forced him to get things straight, and he went on to have a Hall of Fame career. Recessions are very healthy. They're just a sign of the individuals with an economy fixing what they're doing wrong. And so a stock market correction is the same thing. It's just the market's way of rearranging who has access to capital. So it's very, very healthy. So in trying to delay what the markets are trying to do and trying to keep, to basically blunt the market's message, the Chinese government is making what's healthy much, much worse because it's delaying the arrival of buyers who must fill in for the sellers who want out, who want to rearrange where capital's going. So this correction is healthy. Government's just making it much worse.
Now, that being said, I mean, it's your thought from the stuff I've read of yours, including your book, Popular Economics, that the market, if it's a free market, it will set the, shall we say, fair price of what's anticipated in the future for that commodity or that service or whatever. Is that what you're saying? Is the Chinese market, and it's trickling into ours, but they're preventing the market from establishing the fair price of things?
Exactly. And so that scares away investors. If you don't allow sellers, as a rule, you don't allow buyers in the market. Because how can buyers express their optimism unless sellers are allowed to express their pessimism? And so you need this to happen on occasion. Thank goodness that markets correct what's going wrong in the marketplace. Markets got rid of Blockbuster because it wasn't serving customers in the way that for instance, Netflix wanted to. Markets constantly rid the economy of what we don't want. And so if you delay it, you have Friendster rather than Facebook. Well, does anyone want that? No.
Now, does that work, and I just had this thought, I didn't write this question down, does that work in the opposite way, John? I mean, can powers that be artificially depress a price like oil? I mean, is oil being interfered with so the free market isn't working on oil, or is that the free market actually working on oil?
Well, oil is such a big market, it'd be hard to say that government is in fact, or that someone's manipulating its price. Let's face it, there's always a buyer and a seller. But you bring up an excellent question. Why was oil suddenly, out of nowhere, expensive in the early 2000s when it had been so cheap in the 80s and 90s? Well, it's fairly basic, and I talk about it in my book. This was government error. The Bush Treasury early in the Bush administration sought a devalued dollar. Presidents always get the dollar they want. Mm-hmm. Oil is priced in dollars, right. And so oil never became expensive. The dollar became cheap. And so more recently, in the last few years, the dollar strengthened quite a bit. Mm-hmm. And it drove down the dollar price of oil. But if we had maintained a stable dollar all these years, which is the sole purpose of money, it's just a measure that helps us to exchange goods, right. Oil would never have become expensive in the first place. Americans wouldn't have been paying nosebleed prices at the pump. And in addition to that, there never would have been all this malinvestment in the oil patch in the first place. It was a plentiful commodity that the world was providing very cheaply. Then we decided to devalue the dollar. Big mistake. It was a government error all the way.
So really, I mean, to put it in Midwestern farmer terms, if the price of corn was $50 a bushel, we'd have a lot of people planting corn. And that's kind of the same thing with oil.
Exactly right.
Okay.
100% right. And now think about that. There was just something in the Wall Street Journal last weekend that well over 50% of the oil sold in the world is basically brought to market by corrupt, thieving regimes. Look at who's big in oil. Right. Iran, Venezuela, Equatorial Guinea, some of the most backwards countries on earth. And so what does that tell you? Is it any surprise that the U.S. economy was particularly weak during a period when the oil industry was booming? Well, no, because it signaled the U.S. economy lurching into the kind of work that the most backwards countries on earth can ably do, and away from the kind of work, think technology, that most countries in the world cannot do. It was basically the U.S. economy blasting to the past, doing the work of yesterday, and of course the economy weakened. The weak dollar drove us into industries that, again, Venezuela is good at, that Saudi Arabia is good at, that Russia is good at.
That's an excellent way of looking at it. That being said, I wanted to ask you a couple of questions about the budget that was passed a few weeks ago, but part of that overall bill was lifting of the ban that prevented our country from exporting crude oil. Now, I've talked to a couple economists like yourself about this. How important do you feel being able to export crude? And by the way, today I think was the first tankers that hauled our crude out. How important is that?
I don't think it's very important really at all. I mean, yeah, it's great. Look, free trade bills in the United States should be 1 or 2 words or 3 words. You're free to trade with anyone. And so good. Those who extract oil should be able to sell it to whomever they want. But my take is, and I want free markets, I want markets to dictate what happens. Mm-hmm. But what I believe is if the dollar had been stable all these years, oil would be very cheap. It'd be, more like $10 to $20 a barrel. And the U.S., the most advanced economy on earth, would be importing the vast majority of the oil that it consumes. And to me, I say thumbs up to that because, let's face it, oil's easy. Again, Venezuela can do it. Iran can do it. That's great that we're exporting it, but a country as advanced as ours should be importing prosaic goods. It shouldn't be exporting them. We should be exporting technology. That's what we're best at.
Right. We're talking with John Tamny, editor of RealClearMarkets.com and author of Popular Economics, What the Rolling Stones, Downton Abbey, and LeBron James Can Teach You About Economics. Terrific book, by the way. In a couple minutes we have left, I wanted to touch base, some of the presidential candidates, who shall remain nameless, talking about a fair share tax, increasing a capital gains tax, increasing estate taxes. This is pretty much the opposite of what our economy needs right now, wouldn't you say?
The total opposite, and one of the cruelest things you can do to the poor and middle class is raise estate taxes on the rich and raise capital gains taxes on the rich. Because let's face it, how are companies and jobs created? The only way they are created is when people delay consumption and save and invest. Okay, so who's got the most money to save and invest? Right. Well, it's by definition the rich. Why does ESPN exist today? It nearly went under, and I, of course, talk about this in my book. But for a $10 million investment from the Getty Oil Trust, John Paul Getty left behind a lot of money to his heirs. They had so much money that they were willing to risk it on a high flyer like ESPN. And so we get the true growth. How was Silicon Valley created? It was created by Rockefellers, Vanderbilts. They had so much money to lose that they took risks on the riskiest companies of all. And so who gets to work at these places? Guys like you and me, and so when you tax the rich, the people you hurt are the poor and middle class, because the rich have the money to invest in the companies of today and tomorrow. So it's a really cruel thing to do to the rest of us to fleece the rich right now. Terrible for the economy.
You know, one of the things that I always try to point out on the show and think about that people think that the rich, quote unquote, is a static group of people. And the truth is, rich people get poor every day and poor people get rich every day. That's a constantly fluid number of people. And, you know, people forget that, you know, the rich isn't this group of 20 mean guys sitting in a corner saying, how can we screw everybody and keep it for ourselves? They're constantly changing chairs.
It's the team picture of the rich, to your exact point, changes all the time. Compare a Forbes 400 from 1982 to today. You won't recognize most of the names. Think about the year 2000. Mark Zuckerberg was a high school kid in the year 2000.
Right.
Well, today he's worth, $78 billion?
Something like that, yeah.
And what we also got to remember is, think about what people who I'm not going to inherit a lot of money, but think about those who inherit a lot of wealth, what they can do with it.
Right.
They've got so much money that they can risk it on the ESPNs and, yes, the Facebooks and all these interesting companies that are going to employ us, that are going to change how we live. And so when you tax away the wealth of the rich, you tax away opportunities for the people who aren't rich, for the people who have a dream and want to pursue it. The only way they can do it is if someone will delay consumption and offer up their savings. The rich have the savings. Don't take it away, because you're taking away opportunity from guys like you and me and the listeners.
Now, we've got just a few seconds left. You got a new book coming out in a couple months called Who Needs the Fed? How Taylor Swift, Uber, and robots can end the biggest bank in the world. Can you give us a little preview?
Yeah, it's just a book that points out that the Fed tries to set low rates of credit, cheap credit, but in the real market economy, we have different prices for it all the time. And I use Taylor Swift and Uber as an example to show the Fed tries to make credit easy by decreeing its price zero. What does Uber do? Uber decrees surge pricing to get drivers on the road. It wants to make sure that our needs are served. And so it, in fact, raises the cost of accessing its drivers when we need the drivers most, so that we have access to a ride when it's snowing, when it's raining, when maybe we've had too much to drink. Exact opposite of the Fed. It's a reminder that the Fed's model is totally backwards.
Absolutely. I can't wait to get my copy of that, John, and I hope that we can tap you on the shoulder again when that comes out and talk about it. Your book now, Popular Economics, I agree with some of the reviews on it that you're kind of the modern Henry Hazlitt that wrote Economics in One Lessons. Terrific book, very readable. I gave it to all my employees to read, and really enjoy your work, and appreciate you spending a little time with us today.
Oh, thank you so much for having me. You're so kind to have me on, and any other time you'll take me, I'm glad to do it. It's nice to talk about these things. I really appreciate it.
Well, thank you very much. We'll chat again soon. You be well.
Yes, you too. Thank you so much.
Thank you. John Tamny, Senior Fellow in Economics at Reason Foundation, author of Popular Economics, What the Rolling Stones, Downton Abbey, and LeBron James Can Teach You About Economics. I'm Gary Rathbun.